Hey everybody, Jim Ingersoll here. Welcome back. It's good to see you guys again and hang out with you guys, and hope everybody's doing really well. Thanks for the positive feedback on recent podcasts with George Antone on leverage and Paul White on investing passively in real estate. And right along those lines today, we're going to continue with my guest today because Josh is an incredible knowledge on things like self-directed IRAs, which is one of my absolute favorite topics. And so we're going to dig into that, and we're going to talk about how you do it, how you invest a self-directed IRA into apartments and multifamily, and how you make all of that work. So let me tell you about our special guest today. Josh Plave is the founder of Walden, Maine, and he's a full-time multifamily investor, loves doing apartments, and he's been doing it with his family. They hold a portfolio of 700 units across 3 markets. That's right, 700. He began his retirement account when he was 16, which all of us just dream about doing, when he opened his first Roth IRA and began trading equities. Since then, he's gone on to do all kinds of things regarding multifamily and has a nice portfolio to share with us on his journey. Josh, welcome to the podcast today.
Thanks for having me, Jim.
All right, so let's talk about this. 16. First of all, where did you grow up, and what was your childhood like?
I didn't grow up too far from you, actually. I grew up in Washington, D.C.
All right.
So let's see. My mother and grandfather were both CPAs. So
All right.
I was at a young age kind of given they instilled an interest in compounding growth of dollars and saving for retirement. My grandfather set up all kinds of avenues for us as a family for us to afford for college, and really made sure that he was looking out for our family. So it really put a little spark in my mind at a young age. I know our schools don't really do a great job of hammering home financial independence or our just overall financial responsibility. So I kind of was learning it through my parents teaching me stocks, and my grandfather, who was teaching me importance of retirement. Felt like I should take my earnings from summer camp counseling, being a counselor, and I put it all into a Roth IRA at 16.
I love that. Now, the rest of us are thinking, man, we got to get our kids involved at an early age. So I love that story. And, I got a master's degree, Josh. They didn't teach me anything about compound interest ever. And my degree is in engineering. That's all math and science, no compound interest.
Yeah.
Bizarre. So you grew up in Washington. What area of DC were you in?
Actually in Maryland, Rockville, Maryland.
Uh-huh.
And I recently was actually married in Richmond. So
in Richmond? Oh my goodness.
I've been in your neck of the woods pretty recently, yeah.
Is your wife from this area?
She was actually born in Richmond, but she grew up in North Carolina. So our families are both on the East Coast still. We're in Denver right now, but it made the most sense to meet up in the middle and get married there.
Oh, that is awesome. So you grew up in DC or Maryland, in the DC suburbs, I guess. And then what did you do when you graduated from high school?
I went to school at Northeastern University, where I studied management and marketing. And same as you, even though you studied engineering, I learned how to manage a company, and maybe advertise their services, but I did not learn how to manage my own finances. It's something I had to teach myself, and something that I've been teaching my sisters. I've been helping friends with it as well, as we all kind of launch our careers in our late 20s, early 30s. And I went to work after I went to Northeastern at EMC, which is a cloud computing company now owned by Dell. And so I've spent I had spent the last 7 years working as a data analyst in operations for a variety of Fortune 500 companies. And then when I felt the need to, I've switched over to real estate and used that data analytics skill to kind of help dig into numbers and everything along those lines.
Love it. So, a lot of people getting started in personal finance go to people like Dave Ramsey. And I really like Dave Ramsey. I don't like that. And you got to be careful of leverage. I mean, I understand that whole thing. And for probably 95% of the country, that's perfect.
Sure.
David Bach is another guy out there speaking a lot about personal finance, and Chris Hogan, and people need all that message, but your message has got to be a little different because you've leveraged in.
Yeah, I think there's a great message behind personal debt, limiting your personal debt. I'm all for it. In business debt is entirely different.
Yeah.
It's, you just gotta, need to know how to manage it properly, have the right kind of cash reserves to get through times like these. But I think there are two different thought processes you need to go through to really understand the concept of debt and how it surrounds your overall life.
So how did you start to learn about real estate and things? You started your Roth really young, which is a great vehicle, but you were taught about stocks and equities and things like that. How did you migrate over to the real estate space?
So uh, the first little, I guess, piece of my mind that really stuck with me was when I was a kid. My dad would take me to open houses. I'm sure a lot of us do this. We go to open houses and you see local real estate. And so I'd always been interested in kind of, we'd all seen the last run up up to the last recession, the fix and flip phenomenon. And it's been happening as well now. And so you see a lot of that kind of happening in pop culture. And so you kind of just start having an inkling of what you can accomplish with it. So when my last job, I was at PepsiCo, and they wanted to actually move my job down to Plano, Texas. And I didn't really want to leave Denver. So I decided I was going to go do my MBA. So I actually went to go do my online MBA, and I dropped out in 4 days because I realized that it wasn't going to get me where I wanted to go. It was actually essentially the same thing I had learned when I was in undergrad business school. I had, out of the 4% professors they assigned me, I had 2 of those professors for undergrad. So I actually, I switched over entirely to a self-taught curriculum, and I decided real estate was where I was going to go at that point because I just couldn't stand being in an office any longer. I've always wanted to work for myself. I never really knew exactly. I've had an entrepreneurial spirit. I never could think of a product that I wanted to roll out. And I realized soon that I wasn't kind of like a product and services type of entrepreneur. I was a run a business, manage a business, look at numbers, invest in things type of an entrepreneur, and just understand numbers. So I did a self-taught curriculum. I was all over Bigger Pockets. I listened to all kinds of podcasts just like yours, and really tried to hammer home and figure out where exactly, dial in my message of where I was going to head. Eventually, through all of these different processes, you end up hearing a lot of people say, well, you want to scale up. You want to go from 2 units to 4 to 8. Eventually, someday, I would love to be in multifamily. And everyone kept on saying multifamily, multifamily. So I started looking into it, and I saw a couple speakers speak on the subject, and eventually landed on multifamily as a avenue.
So did you buy single families first and then go to multifamily, or did you dive right in?
Dove straight into multifamily, actually. It took a while to kind of ramp up the actual operation. So what I did was I took my money and I deployed it into private money lending to kind of keep the velocity up while we were starting up operations. But we did start up with multifamily last year, closing on our first deal in Lubbock, Texas.
Oh, wow, in Lubbock. Great. I got friends who live there. Awesome. Good market too.
Great.
Okay, so let's talk about how you did that, because how did you pick Texas and how did you create your fund and start to raise capital and figure out what your investment criteria was?
Yeah. So the deal that I was a part of, I was not one who found it. I was part of the general partner team, and that's one of the great things about multifamily is there's a lot of roles that go into it. So while my main focus is on trying to find deals for my investors, this was one that was found within the group that I operate within, and they found it. I did my own due diligence on the market in Lubbock. Big fan of it now. And I had done previous analysis on markets around the country, and I primarily look in the Carolinas. I look in North Carolina, mostly in Charlotte and Raleigh. And I found that it had a lot of the same features, just scaled down a bit. A nice, diverse economic picture, and heavy reliance on industries that don't really have cyclical natures behind them. So a lot of education, healthcare, government jobs like that. So I was a fan of it from that perspective. I came into it as a capital raiser. I helped bring some capital to the deal. We were raising, I think, about $3 million on the deal. So I helped raise a portion of that, and also put some of my money into the deal as well, since I believed in it.
That's nice. So you have some of your own investment capital in. A lot of syndicators don't like to do that. So I give you a lot of kudos for doing that.
Yeah.
I mean, if you believe in it, I love that. So good for you. So how did you find this deal in Lubbock, or somebody else did? You said
Right. Yes.
you did the due diligence.
Yeah, I did some due diligence behind it, helped them figure out kind of the overall landscape development around the area,
Nice.
and figure out, how it was going to trend over the next 3, 5, 7 year hold.
And so you started taking a look. How big was the complex?
So it's actually a portfolio. It's two separate um, properties. It is
Nice.
a 173 unit
Wow.
portfolio. One was 90 something, I think, and the other was about 80 something. So they're
Right.
roughly the same size.
So that was your first deal. That's a big deal to put together. So you raised about $3 million. Is that around 30% that a lot of syndicators typically target?
As the down payment, like
Yeah.
the equity portion. Yeah. So I think the LTV on that was 75-ish, between
Okay.
70, 75, 77, something like that. And at the time you could have gone all the way up to 80, I think was about the maximum leverage you can get on a multifamily deal. And while some deals require it, and it's not the worst idea on some, we like to stay a little bit more conservative, maybe put more towards capital reserves, plan for a time like this, since it was kind of at the top of a cycle.
So how did you go about doing your due diligence down there?
Yeah, so I wasn't able to actually get down to the property, so we utilized some of the folks who were in Dallas to drive over to Lubbock and do the actual physical due diligence. We have a team we have a vendor that we contact that helps us with multifamily properties around the country. He sends his team. They're able to analyze they walk each unit. I think it's like $50 a unit that they charge. And so we have a team that does that. Property manager puts together a pro forma for us. We analyze that. We take a look at local government bodies. So we take a look at, we get in contact with police, and we ask them kind of what the crime's like there, what the crime's like at local popular shopping areas, where people will want to actually recreate. And we just kind of take a look at any conceivable outside factor that can really affect how your business operates. I think the nice thing behind multifamily and why I got into it is you can focus strictly on forced appreciation. You have a lot of control over the business. It's not even so much real estate. It's more running a business properly that happens to be within the real estate sphere.
Operational excellence.
Exactly. And so we need to take a look at everything outside of our control. We know that we can rely on our own management. Yeah. But we don't necessarily have control over things outside of that. So taking a look at things like that is really important.
Okay, so and that ties back into self-directed IRAs and all of that stuff. You got a great site. It's walldomain.com. Everybody listening should go take a look at that, walldomain.com. But you've really put together great visuals on how self-directed IRAs work.
Thanks.
How critical is that component of raising capital for your syndications been for finding success?
Yeah, I think it's really important to communicate properly how this is going to work for your investors. It's an area that's honestly had a lot of kind of like urban legends attached to it. A lot of people say you shouldn't invest in multifamily or leveraged properties in general with an IRA or a 401k, and it's just not the case. It's an area where you can really maximize the potential in your retirement account. I've tried, as a visual learner myself, I've tried to put together as many visual cues as possible to help understand things like UDFI and its effect on your overall growth and the overall growth in account that you can see from the 5-year horizon all the way up to 11 years I've done. So really helping investors understand what they're getting involved with, since it's similar to discretionary or cash funds, but it's just got a slightly different tweak to it. I think that's been very important.
Mm-hmm. Okay. So which custodians are your favorite ones to work with? Do you have any in mind, if you have 2 or 3 that have been easy to work with?
Yeah, so I actually advocate for checkbook control.
Mm-hmm.
I've opened up 7 or 8 accounts with my family, and we all use checkbook control managed through Kingdom Trust. The funds are sent to Kingdom, and then we open up through our service provider, Safeguard Advisors. They open up an LLC for us. So
Okay.
that LLC is the essentially only investment that the self-directed IRA makes. And then
Right.
once that LLC is established, I can open up a checking account or a bank account and issue wires instantaneously. So as a syndicator, we've actually found that working with custodians often can delay the process.
Mm-hmm.
We've found a couple investors who have almost been timed out of a deal by closing. They've at the 11th
Because they
hour.
did not have checkbook control.
Right, because they didn't have checkbook control, they've been waiting on their
Yeah.
custodian to approve it for weeks and weeks. And as much as we've tried to
Wow.
communicate with the custodian, they just haven't communicated properly and gotten the paperwork completed. So as a result, I think checkbook's just as safe as custodian, to be honest.
Well, usually there's a custodian in behind the checkbook.
Yeah.
And personally, I use trust to get to checkbook, not an LLC, but you can do it either way.
Yeah.
Once you've got it in checkbook control, and I do it through a trustee, then it's very easy as well.
Yeah.
One of the ones I really like is headquartered in Texas, is Quest Trust, and they've got really good customer service.
Great.
So anyway, so it isn't hard to, if somebody's got a 401k sitting at Vanguard right now, and maybe they just lost a job in 2020, they can roll that over and then get control to do alternate investments like multifamily, correct?
Exactly. Yeah,
Not an urban myth.
no, it's a very simple process to get it done. It's no different. I mean, I've done a bunch of rollovers from Schwab to Vanguard, from Vanguard
Right.
to Fidelity. It's the same process. Each custodian will have their own nuances and paperwork, but it's a pretty simple step.
Yeah, it's not hard. So, and then you've got your funds set up, and then you have to be an accredited investor with you?
No,
Yeah.
we tend to do 506B, which
Okay.
is, you have to have a personal relationship with investors, but yeah, it can be anybody. A typical buy-in to a multifamily syndication is anywhere between $50,000 and $100,000. It depends on the actual deal.
Mm-hmm.
But the nice thing behind that is if you don't have necessarily, let's say it's $75,000. If you don't have $75,000, but let's say you have 25 in your account, I don't know how much you guys have covered disqualified persons, but you can't get involved in a deal with like your spouse, for example. If your spouse invests money into
Your kids, it's usually vertical tree.
linear ascendants or descendants.
Right.
And so if they get involved in a deal with cash funds and you're trying to get in with retirement funds, that's a prohibited transaction. Well, their retirement accounts are not prohibited. They're not disqualified persons. So if, let's say, you want to invest into a property with your spouse and your account has 50 and your spouse's account has 25, you can pool those together, meet that minimum amount, and get involved in a deal you otherwise wouldn't have been eligible for.
That's a good tip. I agree. Yeah, it's a nice way to raise funds, right?
Oh, yeah.
So what do you think is going to happen here with the market coming up? We're finishing out, states are starting to reopen, but but on the other hand, like tenants are trying to do rent strikes, and it's a tough time coming up that we're getting through.
It is.
What's your take on it?
It's it's tricky to see kind of where the buck's going to stop because a lot of these regulations that they're imposing or they're proposing really are allowing free rent, or they're forbidding evictions, and they're not forgiving the actual mortgage. So it tends to fall within those maybe on the landlord. So it's a little tricky, but I think things like that will likely get ironed out. As a country, we don't like to see, the reason I got involved in multifamily is it's got incredible tax benefits. It's where the government insists, that they want to place a lot of value in overall economic development. So I tend to think that they're going to try to work to support not just multifamily, but other, all kinds of real estate development, and make sure that people have affordable places to live, and places that they can hold on to and not fear that they're going to lose out on just because they have been affected by COVID. That said, I've recently saw, let's see, 4 or 5 days ago, I think Fannie Mae released their April home buyer, assessment, or their survey, essentially, of who is in favoring buying a home in the next 12 months, renting a home in the next 12 months. And the sentiment definitely favors landlords and those who own properties to rent out. So home buying sentiment is down quite a bit. People think they're going to be renting for a little longer than they expected in the next year. I think a lot of that kind of the overall economic progress of where people are headed is a lot that they're really interested in flexibility and being able to move where they want to, expand when they need to, whether when they have a family or they take in an elderly parent. And that kind of flexibility is really important. I think a lot of people are shifting over to renting more and more every year. And that's kind of why we operate in the space for, a longer time horizon, like 5 to 10 years.
So over the last few years, cap rates have really been compressing and prices have been going up. So the returns are less and less in multifamily. Do you think that's going to shift a little bit?
Yeah, so it's interesting. Typically, you would have thought that they would tend to follow interest rates. As interest rates come down, cap rates compress. We've seen a bit of a disconnect from there as the interest rates really dropped to zero. And then there's still that spread there on an actual mortgage. We haven't seen cap rates compressing dramatically in the last 6 to 8 months. At the same time, I'm not necessarily sure that the cap rates will tend to expand dramatically. There's a good chance they're going to sit where they are. Money needs to find a return. The money's always seeking the best return, whether it's domestic or foreign funds. And so if there's an influx of foreign capital that is seeing similar 0 or even negative percent interest rates then around the world, then you're going to see a lot of money in the commercial space here. And so I think cap rates, they may raise a little bit over the next few years, but it's not going to be much. Yeah, I would imagine they stay fairly level from both directions pushing.
Okay, well, we'll see. It'll be very interesting. I think some landlords are going to be burned out and ready to sell, and others are in it for the long haul.
Sure.
I think, like, my opinion is, like, people that are really good at this will probably be fine. They have cash reserves to get through. Others maybe not. So we'll see how that plays out over the next several months. If one of our listeners is just thinking about getting started and jumping in like you did, looking back, what advice would you give yourself or to them going into as we pull out of this pandemic that we're in?
Yeah, would you say strategically focusing on multifamily or just real estate?
Yeah, multifamily.
Multifamily. So I would. It's interesting. There's some. I would say that some good podcasts out there would be Jake and Gino's podcast.
Yeah.
Michael Blanc has a nice podcast. There are a lot of the real estate podcasts will touch on multifamily, and they'll have those guests coming in. If you really want to focus on them, you need to listen to their stories. You can understand the model of multifamily pretty well, but it's really that experience of understanding all the bizarre possibilities that occur when you own a business that's as large as that. When you're owning a single family home, there's the scope of the issues that can occur is a lot more predictable, but it kind of grows as you get into the commercial space. The nice thing is your team grows as well. So there's a lot more subject matter experts to kind of help. And maybe if you're out of your depth in a certain area, you can rely and lean on part of your team. But it's really important to find those multifamily podcasts that are strictly focused on multifamily. The Think Multifamily podcast is another great one. Dan
Mhm.
Henford has one as well. They're out there, and I would say that's kind of how I got
So
my
you
start.
listen to a lot of podcasts. I love that. And do you
Yeah.
also read a lot?
Yes.
What have
Book
you been
every
reading?
2 weeks. I just finished the most boring book I have ever read, but it's important to read on these kinds of subjects. I read The Big Debt Crisis from Ray Dalio. I
Uh-huh.
thought it was really important to cover that going into this, even though it's a completely different kind of a
I
recession.
really loved his book right before that as well.
Which was that?
It's really thick. Can't
This
think
one
of the
was.
name, but I do like Ray a lot. So,
Yeah.
okay, so it's big and you learned a lot, but it's boring, like a textbook type thing.
Yeah, it's set up in 3 sections. The first
Principles.
kind of
That's
teach you the principles, then
yeah.
it teaches you case studies, and then it kind of focuses on more graphs and a wide variety of case studies in a smaller
Great.
format. But it was a long read, but it's important to learn those types of things. I read books on personal development, on improving your business as well. Try to keep it vast or diverse.
Yeah. Good for you. Great. I love to read as well. I listen on Audible also and podcasts as well. So, all right. So all of our listeners, you go to wall2main.com or just click the link below me and you connect with Josh. Josh, do you have any last words for all of our listeners today?
I guess the only thing I would really tend to shout out is surrounding multifamily and other commercial properties. There is really a focus on that UDFI piece I mentioned earlier. I've developed a UDFI calculator to kind of help you understand
Wow.
what that'll look like within a multifamily deal. I give it to my investors when we're issuing a deal and let them know that, everybody puts out their expected returns for multifamily when they present, but nobody really tends to talk about the tax or what the tax impacts will look like, because you really can't just for cash funds. The possibilities are endless. With self-directed retirement, it's a lot narrower. It's based on the trust tax table, which has two numbers, like 12 and 20%. So it's a lot easier to kind of narrow in and focus on what those returns would be after taxes. So I like to give my investors an idea of what that's going to be. Even if you don't invest in me, there's a lot of information on my site that gives you the idea of what that tax is going to look like. It tends to come on capital gains and not cash flow, but managing it and understanding your expectations is really going to help you get a feel for what you're going to end up with when the deal's over.
Great. I know you've got case studies, you got stuff on taxes, self-directed IRAs. So your site is very well put together and I do highly recommend it. So everybody should
Thank
go
you.
to walldomain.com and connect with Josh. Josh, thanks for being my guest today. Congratulations on everything. You're young and you're so well put together. You've done a really good job getting started. So congratulations.
Thank you very much. I appreciate that.
All right. Thanks everybody for tuning in. We greatly appreciate everybody who's sharing this. Leave us your comments, your thoughts, your ideas, and appreciate everybody who leaves us reviews. We'll see you guys later.